Hey everybody, Tom Berry here with Investor Loan Source and ILS Capital. We are going to get launched here in just a second for the quarterly update on the ILS Growth Fund and the ILS Income Fund. Hope you find it informative. Well, hey there, everybody. Tom Berry with ILS Capital and Investor Loan Source coming to you from Houston, Texas. A chilly Houston right now. We got that cold front that's came in, and I know some of you in the north are laughing at me right now for saying that. But when it gets down to 50 here, we start looking for our mittens and our jackets and our hats. So, like to bring some information to you today. We do these quarterly updates just to kind of give you, several things, really. First of all, of course, I always go through the numbers. That takes like 3 minutes to go through the numbers from the last quarter and just show you what our funds are doing. And then I like to talk about what's going on in the market, what I'm seeing out there, and what I'm hearing when I talk to other investors and folks in the industry. So without further ado, let me jump right into it. And the disclaimer, as always, we are not offering on this broadcast or any other for that matter, any tax, legal, or investment advice. Please consult your professionals for those 3 items. This is not a solicitation for funds. Any investment made should be only done after careful consideration and reading of the private placement memorandum or PPM. Now they've got the lawyer talk out of the way. Let's jump into the numbers for the last quarter. And I know these are getting really boring for most of you because they're not changing much, which is a good thing, right? We don't want, at least here with our funds, we don't want things that have these crazy swings up and down. And with the Growth Fund and Income Fund, we certainly do not have those things. I'll use my cursor here. We'll go down here to Q3 2022. This is the fund performance, and we like to look at things in a rolling 3-month average. That takes out any volatility that we might have had, which, as you can see from our numbers, is not much. So last Q3 2022, for the 3 months, this fund, which is the Growth Fund, averaged 13.167%. We, at the end of the quarter, had $66.7 million in partner capital in that fund. And if you want to take it out even further and look at our trailing 12-month average, Q3 2021 through Q3 2022, you are looking at a fund performance of 12.95. So very consistent. And we like to show the history here as you start clear back here at Q4 2020 and look across at these numbers. This is the consistency that we're looking for. We want to be in that 12% range for fund performance, because that is going to return to investor the number that we want to return, which we'll go over that one in the next slide. On the income fund, the partner fund over here, we have got Q3 numbers down at the bottom of 11.863. So we're just under the 12% mark on this one. And if you recall, that is way, way, way above our target and what we expected to return on this fund. Partner capital, again, is climbing on this. We are at $9.6 million in this particular fund. And the trailing 12, again, looking out at a further longer period here, is 11.298. So when we look at the numbers, when we look at a trailing 12 versus a trailing 3-month period, and we'll start over here at the Growth Fund, you'll notice the trailing 12 on this column is 12.95. The trailing 3 is 13.167. So what that means is that this fund is still trickling upward even in our current environment. And I'll talk about why that is here in a minute. We look over at the income fund. Even though this is way above target, way above where we expected it to be and wanted it to be, If we look at the trailing 12 versus the trailing 3, again, we'll see that the 3 is higher, which means that one also is creeping up, meaning we're averaging more and more profit off of both of these funds, even in the last 3 months. Now, that is actually a good indicator for us. If I go back and look at the last quarter, prior to this one, we'll notice that the trailing 12 was 12.99 on the growth fund, and the trailing 3 was 12.8. Real close to the same thing there, not a lot of change. And then over here on the income fund, trailing 12 was 11.175, trailing 3, 11.5. So the income fund has been trickling up, up, up. We could go back and look at this. We'll go to the next slide, and then I'll get into the whys of these things once we go through your returns, which is what you really want to see. So as you may recall, both of these funds have no management fee, which simply means all the profit is this slide. All the profit from this fund, all the profit from both of these funds is put in the kitty and split 80-20 between the GP, that's us, and the LPs, that's the investors. After that 80-20 split, this is the ROI, the return of investment to you, the limited partners. And if we look down here, these are, again, 3-month rolling averages for growth and income. Go down to the bottom one here, quarter ending September 22. Growth fund returned 10.52 for the quarter, and income fund 9.49. I will repeat this like I do on every one of these updates. The target on the growth fund is 10 to 12% to investor, and you are sitting right at 10.52. And if we look back at history, look up through here, we would have to go clear back to November 2020, where we just missed target on this fund at 9.909. It was a real close miss there. But every quarter since then, we have hit that target and been in that 10 to 12% range. Income fund, the goal on this fund, or target, I should say, is 7 to 9%. And we hit 9.49. And if you look up through here, we can't find a quarter on this chart that we have not been in or over target with that fund. When we look at those numbers on a graph, you've got the growth fund in blue, the income fund in yellow or orange here. And as you can see, right in target, not a lot of volatility. Guys, this is what we're looking for. This is what we've been trying to do. And this is what we've been accomplishing for a number of years with these funds. So why are our returns ticking upward? Well, here's why. The income out of both of these funds is derived from one simple thing: interest income. And guess what? Interest rates have been rising. As they have risen, we have started to inch our interest rates in our lending company up, which means the notes that we're buying in these funds from our lending company are coming into the fund with a little bit higher rates. We've not been cranking them up to the point where we're going to hurt market share, but we're certainly increasing them so that we can increase the return to investor. And I actually firmly believe, as we go to the next slide and talk about some of the things that are going on out there, I firmly believe that we'll be able to continue to do that over the course of the next minimum of 3 months. We'll be doing, and we do this every quarter. We look at every interest rate, we look at every fee, we look at every structure of our loan programs, and we make adjustments. We've been doing that for years and years. We continue to do that on a quarterly basis, and we're going to be making some adjustments this week for the fourth quarter that would lead me to believe that this trend is going to continue for us. meaning we'll be able to inch those returns higher. Now, there are more things that go into the return on these funds than just the interest rate on the notes. Availability of notes certainly plays into it. How quickly we can take capital from a paid off note and get it redeployed into another note. Those things are important to us as well to bring those good returns that we're trying to bring. But right now, we're seeing a strong deal flow. I don't really see that as an issue. We've just cast a wider net. We're constantly creating new loan products that we believe the market needs. So thus far, as you could see, let me go back a couple of slides here and look at the investor capital, partner capital in the growth fund. Q4 2020, we ended the year with $11 million in that fund, and we ended the year, that same year, in the income fund with just under $1 million. So for a total of $12 million in these two funds. The question when you're building a fund is always, is it scalable? Is your model in your fund something that you can still deliver strong returns at a larger scale than you were doing at a smaller scale? And I think we've answered that question certainly this year, if not sooner, because third quarter 2022, we went from 11 million to 66.7 million, and we went from 1 million to just under 10 million. That's a total combined of over $76 million between the two funds, up from 12 million. So an extreme amount of growth, but we've still been able to keep the same yields, the same profit, the same returns that we were doing at the lower numbers. That's a huge test that we had placed upon ourselves, and I think we have certainly passed that test. Now, we had a due diligence trip for Freedom Founders Mastermind here in Houston a couple of weeks ago, and somebody asked the question, how big do you want to get the funds? And I said, I don't know, but that's one of the things that we're watching on a quarterly basis is, can we keep that capital working? And if we can keep that working, and if we can keep those solid returns, then we know we're okay at that size. If at some point we have a challenge getting that capital working, we may cut it off and say, hey, we've got enough right now. We don't have enough deal flow from more capital, so we're just not going to accept any more capital. And by the way, we don't have to. So when that happens, we'll cut it off, but we don't see that in the foreseeable future. Inflation. We've still got strong inflation readings, which means, in my mind, obviously I don't have a crystal ball or an into the Federal Reserve's mindset or thought process, but in my mind, I believe we're still going to see higher interest rates coming. I don't know if they'll be as fast and furious as the previous ones, but I don't believe the Fed is going to let off. In fact, they've been telling us this week they're not going to let off. Inflation readings in the CPI and PPI of well above 7% is still way out of target for the Fed. And I believe we're still going to see that happen. When we continue to see those rates increase, those are going to flow down into the capital markets and into the lending markets. In particular, when that happens, we'll constantly keep a watch on that, and where possible, where it still allows us to market and get those loans and get those notes that we need to fill our funds, we will still increase our rates where we can. Real estate market. On the single family side, things are slowing down. You've seen that in the news. Let me tell you some things you might not have been seeing in the news. Wholesalers in the in the wholesale side of the single family market are having a hard time selling their contracts. The flippers are really slowing down. A lot of the flippers that I'm talking to are stopping their purchases, or they are demanding heavy discounts in the purchase price of those contracts and those properties. And that's a result of them not being able to sell them nearly as quickly as they have been over the past 5 years. Honestly, this is not something new. What it is a return to normality. What we've been experiencing the last 4 or 5 years in the flipping industry is not normal. Now, it was a not normal for a long period of time, which made people think it was normal. In fact, a lot of the flippers in the business today believed it was normal and may still be of that mindset, but it was not. When I got in this business, there were fundamentals that were taught to me that were real simple. If you were buying a house that was a busted up property, you were going to go in and fix it, clean it up, rehab it, and flip it on the retail market to a homeowner buyer. You needed to buy that property at 70% of what you expected to sell the property for, minus all your repair costs. And that extra 30% margin left you room for oopses. It left you room for your holding costs, for your closing costs on both sides, realtor commissions. And by the end, you got out of that house, if you made a 10% to 15% margin, you did really well. That was the fundamentals that were taught to me clear back in the 2004, 2005 range. And those fundamentals, people in the flipping industry have not been following for years. Now they're returning to those numbers. And as a lender, we've held them to those numbers all along. We've told people, look, if you want to pay 80% minus repairs for a house, God bless you, go do that. I wish you all the best. But that extra 10%, you're bringing it out of your own pocket. We're not going to lend you that extra 10. And we've been doing that for years. So for us, we're really not changing anything. We're not having to. Now, one of the changes that we have had to make as it pertains to single family is looking at the appraisals. We want to look at an appraisal and try to determine what do we think this house will sell for in 6 months, not what would it sell for today. So oftentimes we're taking a look at those appraisals and we're shaving numbers off of them. The appraiser might come back and say comps, which is past, right? Comps justify that this house will sell for $300,000. We may look at that appraisal and say, yeah, in the past that was true, but with what's currently going on, we're going to pop it in at 275, and we're only going to lend 70% of that 275, not 70% of 300. So hopefully that gives you a little insight into how we look at these single family notes that we're doing and putting in the fund. By the way, we have not seen an uptick in our foreclosures. We have not seen an uptick in our defaults. So we believe that those guidelines and those underwriting criteria that we've been using are going to be solid going forward. On the commercial side, we're seeing a little bit of softening. In the commercial side, cap rates, capitalization rate, that is, which is the calculation is used for evaluating the value of a commercial asset. Those are increasing a little bit, which means prices are decreasing a little bit, but there's not a lot of change at least in the asset classes that we're working in. Now, if you're looking at hotel, motel, if you're looking at office buildings, things of that nature, there's been a huge softening there ever since COVID started. But we're not doing those asset classes. We stay away from those because of the current volatility there. So we're not really seeing a lot of change there. Hopefully that gives you a little insight into what we're seeing in the marketplace today and how we're reacting to it. Again, economies of scale. We love that we are growing these funds in a responsible and proper way. The growth of capital in those funds, as you could see earlier in this presentation, has been extreme, but it has not hurt the returns in any way, shape, or form. We are looking to continue to grow them. So if you know anybody that should learn more about them, let them get a hold of us, and they can reach out to us at invest@ils.cash, or you can certainly copy me or just come straight to me at tom@ils.cash, and we'll be happy to talk with them, get them a PPM, and see if this is something that they might be able to benefit from as well. It just gives us more buying power in the marketplace, and those that are large typically get those deals offered to them faster because people assume that we can move quicker. And so far, that has been the case. So I hope this was educational and informative for you. If you have any follow-up questions to this, by all means, reach out with an email, tom@ils.cash. I'm happy to have those questions. And if the answer is a little too long, I may just give you a call. So please include a cell phone number or a way I could contact you if a quick little typed answer is not sufficient for the question. And with that in mind, y'all go out there and have a great quarter, finish the year strong, and I will see you on the next video in January.
Well, I hope that was helpful for you. Each quarter, we're going to do these types of videos so that I can bring you the latest information, the latest things that I'm seeing as I travel around the country and talk to other investors, other real estate guys, other fund managers, and so forth. And I just really want to bring the knowledge that I'm able to pick up because of my network back to you so that you have a comfort in working with us and that you know that we've got our finger on the pulse of what's going on out there. So, as always, if you have any questions, reach out to us at tom@ils.cash or alex.davis@ils.cash, and Alex or I will certainly be able to help you.